What is Forex? Forex, FX, is the marketplace where various national currencies are traded. The foreign exchange market, Forex, FX, or currency market, is a global decentralized or over-the-counter, OTC, market for the trading of currencies. This market determines foreign exchange rates for every currency. It includes all aspects of buying, selling and exchanging currencies at current or determined prices. Traders post their orders to buy and sell currencies on the network so they can interact with other currency orders from other parties. The Forex market is open 24 hours a day, 5 days a week, except for holidays. People know it by many names like foreign exchange, Forex market, FX, currency trading. A decentralized global market where all the world's currencies trade. Traders consist of banks, businesses, governments, investors and retail traders, like me, who speculate on currencies. Forex trading is the speculation on the price of one currency against another. Most liquid market with an average daily trading volume of plus $7 trillion. Not even all stock markets combined come close. Oversight? There is no central marketplace. Trading is conducted over the counter. It's not like stocks where there is a central marketplace with all orders processed like the NYSE. Forex is a product quoted by all the major banks, and not all banks will have the exact same price. Necessary for a Forex trader. The 4M. Man, you. Material, money for capital. Machine, PC, laptop, mobile, internet connection. Method, trading system, platform OTTFX. Exchange rate. The value of one currency expressed in terms of another. For example, if euro to US dollar is 1.3200, then 1 euro is worth 1.3200 US dollars. US dollar to Indian rupee is 82.63, then 1 US dollar is worth Rs. 82.63. PIP. The smallest increment of price movement a currency can make. Also called point or points. For example, 1 pip for the euro to US dollar equals 0.0001 and 1 pip for the US dollar to Japanese yen equals 0.01. Leverage. Leverage is the ability to gear your account into a position greater than your total account margin. For instance, if a trader has $1,000 of margin in his account and he opens a $100,000 position, he leverages his account by 100 times, or 100:1. If he opens a $200,000 position with $1,000 of margin in his account, his leverage is 200 times, or 200:1. Increasing your leverage magnifies both gains and losses. Below you will find some typical take-profit targets for the different time frames. M1 chart, aim for 10 to 25 pips. M5 chart, aim for 20 to 35 pips. M15 chart, aim for 25-40 pips. M30 chart, aim for 30 to 75 pips. H1 chart, aim for 50 to 120 pips. H4 chart, aim for 80 to 200 pips. D1 chart, aim for 125 to 300 pips. The exchange rate of two currencies is quoted in a pair, such as the EURIST or the USD/JPY. The reason for this is because in any foreign exchange transaction you are simultaneously buying one currency and selling another. If you were to buy the EURIST and the euro strengthened against the dollar, you would then be in a profitable trade. Bid and ask price. Bid price. The bid is the price at which the market, or your broker, will buy a specific currency pair from you. Thus, at the bid price, a trader can sell the base currency to their broker. Ask price. The ask price is the price at which the market, or your broker, will sell a specific currency pair to you. Thus, at the ask price you can buy the base currency from your broker. Spread is the difference between the bid, sell, price and the ask, buy, price of a currency pair. Most Forex currency pairs are traded without commission, but the spread is one cost that applies to any trade that you place. Buying. Long. When we go long, it means we are buying the market, and so we want the market to rise so that we can then sell back our position at a higher price than we bought for. This means we are buying the first currency in the pair and selling the second. So, if we buy the EURIST and the euro strengthens relative to the US dollar, we will make money. Selling. Short. When we go short, it means we are selling the market, and so we want the market to fall so that we can then buy back our position at a lower price than we sold it for. This means we are selling the first currency in the pair and buying the second. So, if we sell the pust and the British pound weakens relative to the US dollar, we will be in a profitable trade. 2 ways to analyze the market. 1. Fundamental studies the reason behind a price movement, whether such factor be economic, political, or some other event. Example: trade balance, durable goods, order, employment, industrial production, retail sale, interest rate, consumer price index, non-farm payroll. 2. Technical focuses on the price and its movement or looks for the pattern using history. Example: relative strength index, stochastic oscillator, moving average, top and bottoms, double bottom, Elliott wave, hammer formation, flag formation. The most commonly traded currency pairs in the Forex market by volume. Currencies must be traded in pairs. Mathematically, there are 35 different currency pairs that can be derived from just 8 currencies alone. However, the total amount of currency trading involving these 18 pairs represents the majority of the trading volume in the FX market. This manageable number of choices makes trading a lot less complicated compared to dealing with equities, which has thousands of possible choices to choose from. A cross-currency refers to a currency pair or transaction that does not involve the US dollar. A cross-currency pair is one that consists of a pair of currencies traded in Forex that does not include the US dollar. Common cross-currency pairs involve the euro and the Japanese yen. Currencies that should move in the same way are euro to US dollar and pound sterling to US dollar. Euro to US dollar and NZD/USD. US dollar to Swiss franc and US dollar to Japanese yen. Australian dollar to US dollar and pound sterling to US dollar. Australian dollar to US dollar and euro to US dollar. Currencies that should move in the opposite way are euro to US dollar and US dollar to Swiss franc. Pound sterling to US dollar and US dollar to Japanese yen. Pound sterling to US dollar and US dollar to Swiss franc. Australian dollar to US dollar and US dollar to Canadian dollar. Australian dollar to US dollar and US dollar to Japanese yen. The main point is to spot the situations when, for example, the currency pairs Euro/USD and GBP/USD will move against each other. Or for example, GBP/USD and USD/JPY will move in the same way. If such situation will happen, we have two options. 1. If the Euro/USD goes up and GBP/USD down, it will greatly increase the Euro/GBP. Conversely, when will the Euro/USD go down and GBP/USD up, then Euro/GBP will drop heavily. So we can trade the cross-currency pair. What is CFD trading and how does it work? A contract for difference, CFD, allows traders to speculate on the future market movements of an underlying asset, without actually owning or taking physical delivery of the underlying asset. CFDs are available for a range of underlying assets, such as shares, commodities, and foreign exchange. What can be bought or sold in the foreign exchange market? Forex market is just like any other market where instead of foods, goods, or services people are trading currencies. 10 main benefits of Forex trading. 1. It's a large and global market. 2. It's good for beginners. 3. You can trade 24 hours a day. 4. There are low transaction costs. 5. You can benefit from leverage. 6. It's a market with high liquidity. 7. Volatility of the Forex market. 8. You can buy or sell currency pairs depending on the market. 9. There's good technology for trading. 10. It's well regulated. How are transactions carried out in the Forex market? Before you trade, you need to follow a few steps. Select a currency pair. When trading Forex, you are exchanging the value of one currency for another. Analyze the market. Read the quote. Pick your position. Entering a buy position. Entering a sell position. Get started with octafx.com. Foreign exchange transaction refers to purchase and sale of foreign currencies. The transactions are done with an exchange of a specific country's currency for another at an agreed exchange rate on a specific date. How can I earn from Forex? People would buy a currency pair at a lower price and sell it at a higher price, and their income is the difference between the buy and the sell price. Broker gets a tiny commission from your trades called spread. Who makes money in the foreign exchange market? What are the 3 types of currency? Most modern monetary systems are based on fiat money. Commodity money derives its value from the commodity of which it is made, while fiat money has value only by the order of the government. Money functions as a medium of exchange, a unit of account, and a store of value. What is a currency pair? Key takeaways. A currency pair is a price quote of the exchange rate for two different currencies traded in FX markets. When an order is placed for a currency pair, the first listed currency or base currency is bought, while the second listed currency in a currency pair or quote currency is sold. What are the pips in Forex? A pip, short 4 percentage in point or price interest point, represents a tiny measure of the change in a currency pair in the Forex market. It can be measured in terms of the quote or in terms of the underlying currency. A pip is a standardized unit and is the smallest amount by which a currency quote can change. How many pips is a point? 1 pip equals 10 points, thus, a point is 1/10 of a pip. What is the largest Forex trading session? European Trading Session, London. European Trading Session. London is the largest and most important Forex trading session in the world, with roughly a 34% market share of the daily Forex volume. What is the most aggressive trading session? The U.S/London markets overlap, 8 a.m. to noon EST, has the heaviest volume of trading and is best for trading opportunities. The Sydney/Tokyo markets overlap, 2 a.m. to 4 a.m., is not as volatile as the U.S/London overlap, but it still offers opportunities. Practice. How do I open a demo account? How to open and set up charts in MetaTrader 4. How to open an order in the Forex market. Before you trade, you need to follow a few steps. Select a currency pair. When trading Forex, you are exchanging the value of one currency for another. Analyze the market. Read the quote. Pick your position. Entering a buy position. Entering a sell position. Get started with octafx.com. How to open orders in Forex. Examples of Forex trades and pending orders for beginners. Types of orders. The most common types of orders are market orders, limit orders, and stop-loss orders. A market order is an order to buy or sell a security immediately. A limit order is an order to buy or sell a security at a specific price or better. A stop order is an order to buy or sell a stock once the price of the stock reaches the specified price, known as the stop price. When the stop price is reached, a stop order becomes a market order. What is buy and sell in Forex? As per the general rule of the Forex market, a trader can purchase and sell the currency pairs easily from the market. There's no time limit of buying and selling, and traders can do transactions anytime to make maximum profits. Who are the bulls and bears? Investors are often categorized as bulls and bears. A bull by definition is an investor who buys securities because they believe the market is going to rise, upside, whereas a bear will sell securities as they believe the market is going to turn negative, downside. What is take profit? What is stop loss? T/P. One of the most important pre-calculated price levels used by traders today is called take profit. This is a type of pending order that is placed to close a profitable position once the market reaches a specific price. In other words, it takes the profit as it closes the position. Take profit is abbreviated as T/P. S/LA stop loss is designed to limit an investor's loss on a security position. For example, setting a stop-loss order for 10% below the price at which you bought the securities will limit your loss to 10%. Forex trading is not an ATM machine. Thank you very much for finishing the first chapter of the Essential Guide to Forex Trading book.